It's critical to have a good understanding of margin when trading, especially when trading Forex. Without a good understanding of margin when trading Forex, you will not understand how to manage risk. Margin not only applies to Forex trading, you can also use margin accounts for stock trading, futures trading, and other ways of trading too. A major appeal of Forex trading is the ability to be able to trade with margin. Despite this, margin trading is still commonly misunderstood, or sometimes completely overlooked by many Forex traders. We'll start by going through what margin is when trading Forex with example scenarios for each to help you understand it. As you can see from the list, we will then go through used margin, free margin, margin level, margin call level, and then stop out level. Each of these will be explained in 6 separate parts with examples to help understand them. The idea of using margin is that you can use your money to control a larger position in a market that you otherwise could not. A margin trading account is simply a brokerage account that allows the trader to use money borrowed from a broker to trade. Your margin refers to the amount of equity a trader has in their margin brokerage account. Using margin to make a trade is like using the equity in your account as collateral for a loan. You're borrowing money so you can place a larger position size for your trade or investment opportunity. The required margin is like a deposit, which you will get back once you close out your trade positions. The cost from using margin is the interest cost, which is usually a relatively small amount compared to the size of the trade. The amount of money you borrow compared to the amount of equity you have is referred to as the amount of leverage you're using. For example, if you want to trade using $2,000 and your broker requires $1,000, then your leverage is 2 to 1. Leverage refers to taking on debt, and margin refers to the actual debt or borrowed money. Basically, you are using margin to create leverage. So, to make it simple, margin is the money borrowed from a broker, and leverage is the measurement of the money borrowed compared to your equity. The leverage measurement is shown as a ratio. For example, the current max leverage for Forex majors is 1 to 30 from most regulated brokers. This means you can get up to 30 times a greater position size in Forex majors with your equity. When using leverage, it's important to know that both losses and gains will be magnified as a result. Even though they are interconnected, leverage and margin are not the same things. They are both commonly used terms in the financial world, therefore it's very important to understand this if you want to have a good understanding of margin trading. Now that you know what margin is, we will go through some of the common terms related to margin when trading. Used margin and free margin are important metrics in a margin trading account you must understand. Here is a list of the key margin trading account metrics you should have an understanding of. You will likely have all of these metrics in your trading account terminal. To understand used margin, we must first understand what the required margin is. The required margin is specified by your broker, or you can use the leverage amount specified by your broker to work this out. For example, if you're trading Forex majors, it's likely your max leverage is 1 to 30. So your margin requirement is 1 divided by 30, which is 0.033, which means it's 3.34%. If leverage is 1 to 50, then it's 1 divided by 50, which is 0.02, so it's 2%. Let's say you want to make a trade worth $50,000 with 1 to 50 leverage. We know that 1 to 50 leverage is 2% margin, therefore we need $1,000 to make that $50,000 trade. It's important to note that margin requirements are not fixed amounts. Brokers will fluctuate the margin required depending on factors such as market volatility during a particular time of the day, for example. With regulated brokers, the margin requirements for Forex markets stay within the specified amounts during the main trading hours almost always, so it's nothing to worry about. Used margin is simply the total of all your required margin to keep all your trades open. In other words, it's simply the sum of all required margin being used. Let's say, for example, we have an account of $50,000 and we want to trade GBP USD with a $50,000 position, which has a leverage at 1 to 30. This means the margin required is 3.34%. Therefore, the required margin for this $50,000 position is $1,670. Now, let's say you want to enter another trade while the GBP USD trade is running. Let's say this second trade is a $100,000 position, which is one standard lot. Let's say this position is to go long USD CHF, and it's 1-to-30 leverage, so you'll need 3.34% margin. 3.34% of $100,000 is $3,340. So when you add this $3,340 to the $1,670 from the first trade, you get $5,010 as the total. This total of $5,010 is the used margin figure. To understand used margin, we first needed to understand required margin, which simply is the position size value multiplied by the margin requirement. It's important to remember that margin is used from your account equity and not your account balance. Next, we will go through what free margin is. Since we now know what used margin is, we can easily understand what free margin is. Free margin is the difference between used margin and equity. Therefore, it's simply referring to the equity that's not tied up in open trade positions. Free margin is also sometimes referred to as usable margin, as it's the margin that you can use for new positions. Take a look at the diagram to see how you would work out your free margin based on the example we just used for used margin. When free margin is at 0, then new positions cannot be entered. This is simple enough to understand since we went through used margin earlier, so we'll now move on to what the term margin level means. Since we know what used margin is and how to calculate it, we can also understand what the margin level is. The higher the margin level percentage means the more free margin you have available to trade. Using the example from earlier, where we had two positions open using $5,010 in total from a $50,000 account, we can calculate the margin level. Let's say both positions were at break even, therefore your account equity is the same as your account balance, which is $50,000. The margin level would be $50,000 divided by $5,010, which is 9.98, which we multiply by 100 to give 998%. 998% means the margin level is high, therefore it shouldn't be an issue entering more trades at the same time. The lower the margin level percentage figure means the greater the used margin compared to your equity is. For many brokers, the margin level percentage is limited to no less than 100%. If this is the case with your broker, then you need to be aware of this so you don't use up all your margin. It's important to know that if any of your open positions go into drawdown, then your equity will decrease, and this will impact your margin level. As we now know what margin level is, we can understand what a margin call level is. This is because the margin call level is when the margin level has reached the limit. Many brokers have a margin call level set at 100%, so if your margin falls below 100%, then a margin call will occur. This used to be a phone call, but these days it usually means your broker will notify you via email to tell you this. The two terms traders need to know is that a margin call level is the threshold limit of the margin level, for example 100%, and the margin call is just the event where your broker takes action. To help explain how a margin call can happen, let's take a look again at the earlier example where we had a $50,000 account and two open positions. The first long position on the GBP USD for $1,670 used margin, and the second position was long USD CHF with $3,340 used margin. Let's say the first trade stayed at break even. However, the USD CHF trade goes into drawdown by 4,499 pips at $10 per pip. The unrealized loss for that trade is therefore $44,990. Add $44,990 to $1,670 and you get $46,660, which means you will get a margin call if the broker's margin call level is 100%. Even though you did not close out either of your two trades for a loss, you still had a margin call. Before being able to enter another trade, you will have to wait to see if the market reverses in your favor or if you can deposit more money into your account so your equity becomes greater than your used margin. Another option, of course, is to close out existing positions. Now that you know what a margin call level is, you can easily understand what a stop-out level is. A stop-out level in Forex trading is when your margin level falls to a percentage level, which means one or all of your open trades are closed automatically. So if your account goes below the margin call level, then you'll get a stop-out level. This is similar to the margin call level, except it's worse because your open trades must be closed to meet the broker's margin requirements. If you have more than one position open, the broker will close the position with the largest unrealized loss first, followed by the next biggest unrealized loss until the margin level is above the minimum amount. This is the worst scenario for any trader, therefore it's very important you're aware of this. Margin trading amplifies your returns for better or worse, therefore it's critical you are aware of margin calculations so you can manage risk. If you found value from watching this video, or you'd like to learn more about trading risk management, consider subscribing and click the bell icon for notifications. Also, don't forget to click the like button if you enjoyed it. Until next time.